Hello and welcome to World Insight, live from Beijing. I'm Tian Wei. Oil may be one of the world's key commodities, but the coronavirus pandemic has brought the fuel industry to its knees. On Monday, oil prices plunged into negative territory. This might mean producers ended up paying buyers more than $37 a barrel to get oil off their hands. Oil prices had an uptick on Tuesday, but not that much. So what does it mean to the overall economy, and what does it mean for the future of the oil industry? Before we loop in our panelists, take a look at this backgrounder.
Empty streets, few trips, stagnant oil. With lockdowns came a steep slump in the demand for oil, with fuel still pumping out and nowhere left to store it. Too much supply spelled disaster. On Monday, oil prices headed for catastrophe. For the first time in history, U.S. oil dived into negative territory, a death knell for the entire industry. That means oil producers are paying buyers to take the commodity off their hands. The price of a barrel of West Texas Intermediate, the benchmark for U.S. oil, fell as low as minus 37.63 a barrel. Meanwhile, Brent crude, the international benchmark, was down 8.9% at less than $26 a barrel, the lowest in 18 years. Downplaying the historic drop as a short-term problem, U.S. President Donald Trump sought to buy millions of barrels of oil to top up the nation's strategic reserve.
We're filling up our national petroleum reserves, the strategic reserves, and we're looking to put as much as 75 million barrels into the reserves themselves. That would top it out. That would be first time in a long time it's been topped out. We'd get it for the right price.
A little over a week ago, OPEC members and other big oil producers such as Russia agreed to slash global output by about 10%. The deal was the largest ever cut in oil production, but it won't take effect until May 1st. The oil storage capacity of the U.S., both on land and sea, is filling up. Since March, stockpiles in some locations have risen by 50%. Oil is traded on future contracts, and fears of not finding a place to store oil sent prices tumbling. Traders are now paying to get rid of oil instead of buying it. Black gold may keep the wheels of industry turning, but a constant supply is too much too soon in a time of slowdowns and lockdowns.
More about that. I'm first joined by Willem Lee, the chief economist of the Milken Institute. Before we have also our access to our Chinese expert. Mr. Lee, good to see you.
Good to see you.
Thank you for waking up early to talk to us from the Los Angeles Times. Thank you, sir. Mr. Lee, tell me more about exactly what this would mean for the future price of the oil. As we know, this is about the May contract price.
Yeah, I hate to go into a very technical discussion, but I'm going to have to because of the nature of the futures market for the oil industry. This is the negative price is not the price of oil. It's the price of the contract that people engage in buying a barrel of oil that's due for delivery at a certain time. In this case, we're talking about the nearest contract is June. And the problem is that most people who buy these contracts don't really have anything to do with oil. They don't want the oil. They're only trying to speculate on the price of oil itself. And right now, what's the technical issue is that anyone who owns a contract for oil has to receive delivery on expiration if they're still holding the contract. And most of these people say, I'm not going to put it anywhere, like I'm not going to put it in my bathtub. So they're trying to desperate to get rid of that contract, and that's why you find that the price of these near-term contracts for oil are dropping like crazy, because 80–90% of the people who are engaged in that trade are not prepared to take delivery. So the implications for the real economy, for China, for Chinese consumers, for gasoline buyers like you and me are very little, because the real price that you should look at is the international price of oil, which is not subject to this weird technical feature, and that's the Brent price of crude, and that's in the 20s. Now, granted, that has come down, and that is a valid concern, because what does it mean? It means that the world economy has shut down, and the producers continue to produce.
Right. Mr. Lee, this has a lot to do with the pandemic that is going on right now, and social distancing, lockdowns, stopping or pause of the economy. So tell me more about whether this will have an impact, let's just say, about the future scale and ways the economies would work. That is the bigger fear, isn't it? The huge change as to how economies would function, whether it has much to do anymore with oil.
Absolutely. That's a great question to ask, because right now, certainly in the United States economy is transforming itself from just a pure consuming economy, oil consuming economy, to one that's also producing oil. In fact, the United States is one of the largest oil producers in the world right now. And so for the U.S., the results are mixed. The lower price of oil is great for consumers because I can buy gasoline at below $2 a gallon. But the producers are hurting, and the producers are particularly vulnerable. And the reason why we're concerned about oil producers is because many of them borrow in the financial markets and they're heavily indebted. In fact, the debt that they borrow is called junk bonds because they are so speculative. And the fear is that if these producers go out of business, then the collapse of that particular segment of the financial market may have consequences that roll out to the rest of the financial markets.
Right.
I don't think that's a real risk, but it's a possibility, and that's what the authorities are watching for.
Right. And now we are also joined in our discussion from Hong Kong, Mr. Hong Hao, who is the Managing Director and also Head of Research at Bocom International. Mr. Hong, welcome to the program. Since we talk about the financial market, I would love to drag you into this conversation. Today, we've already seen some of those buyers of certain stocks or certain financial services related to crude oil prices have been, picking up their argument against the banks where they bought this service from, and were supposed to sue those banks because they thought they lost hugely as a result of the turbulence of the crude oil. So tell me more about that.
Well, I think it's related to the structure of the product. Now, basically, yesterday when the oil futures price plunged well below zero, there was no stop-loss mechanism according to the contract, which there was such a term in the contract calling for stop-loss of, I think, between 20 to 50%. So holders of this product, which is essentially the holders of the underlying oil contract, didn't get the stop-loss protection. So as a result, many of the buyers woke up to find that they not only lost all of their capital, but also owe the bank some money. So I think that's sort of inciting outrage in the investment community.
Right. And this is the very first time, Mr. Hong, if I remember right, 21 years since we have, the oil's future prices goes like this, negative. So have we seen any precedents in the financial markets earlier that we could learn from, or at least to use as a reference?
Well, what happened yesterday was entirely irrational. So basically, everybody was trying to rush out of the door. And because the market liquidity for the May contract was very thin, so nobody gets to get out. So if you look at the trading activities yesterday, basically there was each contract trades for about 5 seconds. So basically, the trading activity was very slow because there was not enough liquidity in the system for everybody to get out. So I think, as a result, the product that we mentioned just now couldn't get out, probably because of a tremendous lack of liquidity in the system. Now, I think previously, I don't think anyone has seen negative price before. After all, you have to incur costs to dig the oil out of the ground, and also you have to pay for the storage as well. Right. So, this is totally unprecedented, and I think the June contract earlier today was experiencing a tremendous sell-down as well, because some of the oil ETF was trying to roll the contract to further out months.
Yeah. Mr. Lee, your comment.
Yeah, I was just going to say, I want to add to Mr. Hong's comment in terms of a policy perspective. The lack of liquidity that he mentioned is such a vital issue. The Federal Reserve has, for example, enacted policies where it became a market maker in various segments of the financial markets, including the corporate bond market. But the key about this market, the futures market for oil, is that it's a highly speculative market. And in that sense, it's not worthwhile for policy to try to protect speculators. Speculators, by definition, are there to make money and lose money in a very big way. And everyone who's engaged in that market is generally a professional and ready to take the gains and the losses. So from a social contract perspective, from a policy perspective, one of the things that we should allow is for these large price volatilities in the futures market to get rid of the bad speculation and also to allow price discovery, because it's very important for the futures market to be operational and operating well and in a liquid way, because the spot price of oil, which is what we are affected by, the long-term contract price of oil is determined in part by this futures market. So from a financial plumbing, regulatory policy perspective, it's important to keep the market healthy, but policy should not go into support prices in these markets.
That's a very delicate balance, isn't it, Mr. Hong, particularly when we are in a pandemic and everything seems to be very vulnerable. Policymakers and policy banks seem to come out even more frequently than they used to be in order just to save everything, quote unquote, but there is a degree that they shouldn't go, no matter how tempted it could be. Mr. Hong.
Yeah, I think so too, but I think central bankers are between the rock and the hard place, especially in the U.S. I think before the crisis, the U.S. system is highly leveraged, and also because of the savings, very low savings in the U.S. Society. So I think people need cash to get by. I still remember when there was a debate on the budget deficit, the budget deficit ceiling. The Capitol Hill was stopped for a few days, and then people had to go out to work at McDonald's and all that. So it shows that how tremendously the system is leveraged. So I would say that at this point in time, even though we're seeing unprecedented amount of liquidity is being pumped into the system, but I would say it's probably what is required right now. Because unless you want the system to collapse entirely, you just have to pump the liquidity into the system.
Well, Mr. Lee, that's the argument always from the financial services, isn't it? They would say, oh, if you don't want everybody to fail, then don't fail us first. Of course, Mr. Hong coming from the financial services, just to be fair here, Mr. Hong, I'm not saying this against you personally, I'm just saying this as a logic. So Mr. Lee, what do you make of that? I mean, the financial services are full of talents, smart people, they know how to argue with the policymakers, but, for the general health of the economy, Mr. Lee, and Mr. Hong, of course, later to respond as well. How should we look at this fund balance once again?
I think one of the things important, as Mr. Hong was mentioning, was to make sure that money gets to the people who need it and the businesses who need it. Yeah. The people who need it are the people who are laid off by the virus. And they're laid off not because they're not working efficiently or because their job is not important. They're laid off because the government shut them down for health reasons. And I think this is true worldwide. So safety social nets are very, very important to ensure that people have adequate income during this shutdown phase, and support for small businesses and medium-sized businesses is incredibly vital so that when we open up again, business can resume without interruption. Now, one of the things that I must say, I used to work for Citibank as their chief U.S. economist, and I have to say that there's a lot of arguments for why the financial system, that the system itself has to be preserved. But no one in the argument would argue, not even the people at Citi, that we should come in and preserve particular markets or particular people who participate in the markets. If you're a systemically important institution like Citi was during the 2008 crisis, the Treasury came in to save that financial system, because if they went down, the rest of the economy would go down with it, and we would go back to the 1930s and witness that kind of terrible depression. That was why we stepped in 2008. Right now, the banking system is very healthy, and all the systemic components of the financial system are being helped by the Fed, providing market-making facilities and liquidity. Okay. Right now, speculators in the oil market, they can take their hits.
Speculative trading, we're not going to support it. Mr. Lee says so. Mr. Hong.
Well, I will have to agree with Dr. Lee.
Sorry?
Yeah.
Did you,
well,
what did
I
you say
have to
again?
agree with Dr. Lee.
Yeah? Okay, go ahead.
I'll have to agree with Dr. Lee. Well, basically what happened is that, if you don't pump the liquidity in the system, for example, the commercial paper market is basically frozen, right? So, corporates who wants to get access to credit, they won't be able to get it. The problem is that, you don't want businesses to fail because of the shortage of cash flow. These are perfectly viable businesses. Some have a very long operating history in the market, and suddenly, just because of a short-term working capital problem, you shut them out of the system. That's probably not fair for them, and also it's really bad for the economy.
Wow.
So I would say that the Fed had done what it had to do, and I think all the experiences from 2008 and also from the 1930s Great Depression actually call for such endeavor from the Fed.
Well, it certainly calls for such endeavor to a certain degree, but it also calls for such endeavor to have a balance, particularly to invest into the real economy rather than just the financial services. There's already counter argument from 2008 and 2009 about the financial crisis of too much money going into the financial sector to save those banks who should be actually saving themselves throughout the years. But I have personally no opposition against the banking services or anything, but let's continue another aspect of this discussion. The two gentlemen with me, Mr. Lee, about the oil industry and its relationship with the general economy. Now, that is very real, and that's certainly crucial as well. How will the impact of the futures market, shall I say, filter in to the real economy of oil and the real trading of oil?
In the United States, as I said earlier, the U.S. Oil industry has become much larger and much larger source of employment, especially the fracking industry. Now, one of the things about fracking is that it is, again, highly speculative in terms of exploration, and very often the wells that they drill are not successful. So in order to support this industry and to allow it to continue to be a competitor in the global industry against Saudi Arabia and some of the other oil producers, President Trump has said that we will try to protect the oil industry itself. That does not say that we want to have every company make money. In fact, the companies that are not doing it well should be closed and collapsed into the more successful companies. So for social policy and for political policy, one of the most important things to look at would be how you intervene into that oil industry to provide the kind of support that preserves employment and also allocates the funding into the more efficient companies. And that is allowing the financial markets to work in a way that is fully functional, but at the same time allowing companies to go bankrupt.
Okay. And Mr. Hong, of course, that's for the United States, what Mr. Lee just mentioned. But there are other parts of the world that are crucial, both producing and also consuming the oil. So, Mr. Hong, what do you make of the earlier interactions among oil producers from OPEC and some of the other economies that are producing oil, try to cut the oil production amount, and yet did not work apparently under the current circumstances. And this time, when the futures market of oil prices dropped to such a degree in the U.S., what does this mean to the real economy of oil?
Yeah, well, I think it's a tremendous hit on demand because of the virus. So even though the OPEC Plus organization is trying to cut, they're not cutting nearly enough. So they're cutting about 10 million barrels a day, but I think the demand shrunk more than 20 million barrels a day. So basically, you're still in excess of a couple of 100 million barrels a day, and it's very difficult to store all those excess oil in the ground and also on oil tankers as well. So I would say that with the price being so negative and also the pressure on price continue to persist, before long you'll probably see some U.S. oil producers starting to shut down production. I think for now they're hesitant to do so, because shutting down oil production can be very expensive if later day you want to reopen them. Right. So I think they are now waiting out, to see whether the price will come back. I think for Chinese oil refiners, though, historically, lower oil price tend to be a good news, and also, supportive for the expanding margin. Now the problem is that now because demand, the end demand got here, so even if you refine all those oil on a cheaper input cost, you still cannot find enough end demand, for your refinery products. So that's why, even though oil price came down dramatically, we're still seeing stock price pressure on those Chinese oil refiners.
Right. Of course, it has a lot to do also the future price of oil with the so-called storage space, 65–75%. Now it's going more than that. So, Mr. Lee, what about that? The real industry, it's really about supply demand, right? It's really about consumption and also production. So how does these traditional logic of the market work in terms of the oil industry as a result of this?
That's a great question, because let's remember how the oil price started to collapse so rapidly. Yes, the lack of demand was a huge contributing factor, but Saudi Arabia declared war on Russia and some of the renegade members of OPEC. So they essentially started pumping like crazy and said, if you don't fall in line with your agreed upon cuts, I'm going to flood the markets and make you go out of business. So that initial war that the Saudis had with Russia was the spark that really created this huge turbulence in the oil prices. Then we tried to have an agreement, and the U.S. President Trump tried to broker a deal with these people and said, look, why don't we try to be reasonable about the amount of cutbacks? Even Texas producers, as a state, the organized producers are saying, if you all agree to stay with your quotas, the United States will also cut back on its production, even though, as Mr. Hong said, it's so expensive and some of it will drive some of our business out of business. It's so important for us to restore order because the world economy depends on stable oil prices. It could be at a declining a low level, but it has to get there slowly and not at this very rapid pace, induced mainly by the virus.
Yes. So, gentlemen, I think it's a legitimate question for me to ask here. So, what's likely to be the logic of this story for the near future? I mean, 21 years, they say, never like this before, but we are experiencing it right now. And pandemic is very unpredictable. Everything about the economy probably will be eventually decided by this virus before vaccine. So, what does it mean? Are we going to see this kinds of unprecedented occurring once and again? Are going to see turbulences, unexpected, at any time of the oil market, particularly the future of the oil market, and eventually filter into the real market, into the pump stations that we are facing every day when driving to work? Mr. Hong.
Yeah, well, I think supply come back in line with demand. I think the volatility in oil price is going to continue, especially if you look at the June contracts, which is probably going to be settled within a month. Now the problem is that you don't seeing storage space getting more, so you're actually getting less and less storage space, and therefore more and more expensive. And also, I'm not seeing enough cuts, from the oil producers, and also the U.S. shale gas producers are not cutting fast enough. So as a result, it's quite likely that if nothing happened, then we're going to see a similar situation when the June contract comes settled.
Well, it's coming. It's coming, Mr. Lee.
I would say that right now the key thing to watch for is that this is a turning point for Saudi Arabia. If Saudi Arabia does not gain control back onto the price of oil, we might actually see the collapse of OPEC, or at least the influence of Saudi Arabia in OPEC. Because if the renegade producers continue to produce at such high volumes, the disaster scenario that Mr. Hong just mentioned may in fact come true. So Saudi Arabia has a great interest now and tremendous pressure on it as the leader of OPEC to be able to try to contain the amount of pumping that's going on among its members. So the thing to watch out for from a policy perspective is what's going to happen to Saudi Arabia, and will OPEC be able to hang together?
Well, this is a quite interesting chess that we're seeing right now. One lead to another, action and reaction, some predictable, some unpredictable, some with strategies, some not be ruled by strategy. So I want to thank both of you. This is this stage of the chess. We'll see what's going to happen next. Hong Hao, Willem Lee, really appreciate it. Thank you so much for your insights.